Back on Ask Annex, always open. Head to our website, annexwealth.com. Look for the Ask tab. Matt Morzy is Director of Research at a CFP. Hey, Matt.
Hey there.
Fred Coleman, CFP and a Branch Director. Hello.
Hey, Danny.
Question 1 on Ask Annex. Reading more about people overextending credit card debt. Student loans need to be repaid at some time. If the economy gets worse later this year, could this wash over to the rest of the economy in general?
Yeah, that's a great question. I actually reached out to Brian Jacobson, our chief economist, on this one to get his insight. And essentially what he said, he's like, this has been a concern for quite a while, really since the pandemic, that, everybody got that huge influx of cash right away. And it's been steadily been spent down, over the last few years. As a part of that, after that got spent down, as credit card debt started to go up, we hit record highs. But consider, over the same time, incomes were still going up, asset values were going up. So when you start to compare the record high debt, you're really comparing against other record highs along the way. So at this point, they're really just average. He said, from a big picture perspective, things are really manageable right now, and it really matters who owns the debt. Some states are different than other states when it comes in terms of population there, in terms of where those debt levels are. And then, you start to think of things like from the banking system of things could really become a problem. And right now you're seeing lower income levels, they have the highest amount of debt burdens relative to that income. But banks have been really preparing themselves along the way. You'll see as banks have their earnings report, they'll talk about loan loss provisions, which essentially is them trying to get out in front of it in terms of loans that they think might go bad. And they're already moving them off their balance sheet or moving them off to the side so that they're kind of protecting themselves along the way. But from right now, people are bracing themselves. The banks are doing that as well. So there's really not that contagion effect or things that we see right now coming out of this.
The financial sector actually did pretty well this last quarter, right?
It did. A lot of that had to do with trading, which is, in terms of more market volatility provides more opportunity for them on that. But, they've really had to, since the financial crisis, had to really raise the amount of capital that they have on their balance sheets. And they're at a spot where they're, much healthier than they were maybe 20 years ago at this point to be able to handle situations like that.
And these things, when student loans, credit card debt, when those things start going up for people, it really forces them to cut back on some of their discretionary spending. So dining out, shopping, travel. And because consumer spending is really the largest part of the U.S. economy, 70%, it can cause a pullback if things significantly, if growth does significantly decline. So there could be a trickle-down effect. If this does affect things, it could lead to layoffs, consumer sentiment. Those are the big things that could cause a slowdown.
Do you guys know, is the pause still on?
It's been 2 years. They've been kind of going back and forth about it. From my understanding, there's a pause. Like they're encouraging you to start paying back, but they're not really enforcing it.
Question 2 on Ask Annex. My friend who will retire later this year has stopped contributing to all their retirement accounts. Shouldn't we all contribute as long as possible? I guess it depends on the plan, right?
Yeah. And for most people, it does make sense to contribute as long as you're eligible, especially in that final stretch before retirement. One of the biggest things that people say to me all the time is they wish they would have put more into those accounts. Because once you don't have earned income, you lose a lot of those tax advantage accounts that you're eligible to contribute to. Now, there's also situations where, not everyone should contribute. The matching contributions, that's pretty much across the line. Get that match. But if your cash flow is tight before going into retirement, you want to make sure you have adequate cash flow. I would put that as a higher priority than contributing. And then if you have already hit your savings goal and your financial plan is tight, then you want to avoid some potential tax issues later, maybe with required minimum distributions and all those things. Then you can start transitioning more into that spending mode. But it's all about your individual plan and what it looks like.
Yeah, I think the biggest thing, there's so much uncertainty with the question in terms of how old they are. Where do they have their money right now? Is it in non-qualified taxable accounts? Is it in traditional IRAs or Roth IRAs? And they might be in a spot where they really need just liquidity. They're going to need to fund their spending right away. They might not necessarily want to pull out of a retirement account, shortly after they retire. And so having more money in the bank right away that they could just pull out of, especially since we've had market volatility now, they might be a little bit more afraid of that having some liquid cash in their checking account or maybe just in a higher yielding savings account is going to work out best for them as they approach retirement in those first few months or maybe a year or so into it.
Yeah, I mean, we really like this segment because I think it shows the audience, kind of how we think. But we can only go with the information that's presented within the question. So, and Fred, as a wealth manager, it really is sitting down and talking and seeing the financials and really talking about goals and how things are going to go. But it's that conversation.
Absolutely. And there's so many things that go into this outside of the numbers. The numbers are just a small part of financial planning. And the art to it is really helping clients figure out how to get to the finish line based on their different goals. No two situations are the same. And that's what I love about it.
Can we help you folks? Investment, retirement, tax, and estate planning is a fee-only fiduciary. Website, annexwealth.com. Click that Get Started button. Fred Coleman, Wealth Manager, Branch Director, and CFP at Annex Wealth Management. Thanks.
Thanks, Danny.
Matt Morzy, Director of Research, also a CFP. Thanks, Matt.
Thank you.